Merry Christmas, happy holidays, and in today's episode we are looking at the 7 best REITs to buy now per Morningstar's latest article that they brought out last week. We're going to run through all 7 of these very high level. We're going to take a look at each one's essential dividend safety, looking at their financial metrics and coming to the conclusion whether or not we believe these individual companies to be a strong undervalued buy now. So all of these do earn Morningstar's 5-star ratings, which means they do believe it to be extremely undervalued. So let's jump into the first company, the first real estate investment trust, and it is none other than Realty Income. Now, what we can see here is they do believe it is currently trading at a 24% discount, and Morningstar do believe the current fair value to be $76. Now, it is in the retail industry within the REITs, but they do also believe this to effectively have a forward yield of around 5.32%. So let's take a look into the metrics. Now, dividend safety score for Realty Income sits at 80. It looks to be safe. Market cap 41 billion, a large cap company. Now, for each one, we will very briefly look at their recessionary metrics. Well, last recession, they increased the dividend in the 07-09 period. Pretty much had flat recession sales. If you remember, though, the average growth is around negative 12 to 13%, so it was above that. And it also outperformed the S&P 500 with a negative 43% return versus the S&P's negative 55%. Dividend growth, well, they have been increasing those dividends for the last full year at 4%, so in line with inflation. And remember, the minimum 4% I do always advocate on the channel to get. Last 5 years, slightly lower at 3%, although the last 20 years at 5% on average. Now, they are a dividend aristocrat. They have increased those dividends for the last 25 years or more. Now, when we take a look at dividend yield theory, it states that the company is undervalued when the current yield sits above the 5-year average, 5.41 versus 4.39, so we do have a sign here of undervaluation. Forward P to FFO ratio, well, it sits at 13.8 versus 18, so another sign of undervaluation. And when we compare it to the real estate average at 14.1, Realty Income sits just a few points shy. Now, when we do normally take a look at the payout ratios for the majority of companies, we focus on the free cash flow, as essentially earnings is susceptible to manipulation by management through accounting. For REITs, we will just be focusing on the adjusted funds from operations, as the free cash flow is a lot more volatile. What we look for here, below 90% is our preference, and we can see here it has in fact been below 90% for the last 10 years, or the majority, with 2022 and 2023 expected to be around 76%. Now, when we take a look at the adjusted funds from operation, very nice to see it has increased year on year very consistently, with 2023 expecting to be the same, going up to around $4, so it is a fairly consistent company. Sales growth 5 to 10%, moderate growth for REITs is what we tend to target, and we can see Realty Income not only has it hit that year on year, but the last 2 years, with 2023 expected to be some very strong double-digit growth to their top line. And for those that like to see the numbers, 780 million in 2013 to 3.34 billion in 2022. Now, one thing that we love as investors is when companies do share buybacks, returning excess cash to our pockets. Now, for REITs, it is very typical to see the opposite, where they dilute your position as a shareholder, issuing equity. The reason for this is to fund property acquisitions, given the fact they do retain a little of that internally generated cash flow after paying dividends. So as we go through the episodes today, do take a look and you'll see the different REITs do dilute your position at a different rate. ROIC for REITs, 3 to 5% to ensure that management are effectively allocating their capital. 2022, 3%, 2023 expected again at 3% too. Operating margin, as we can see, very nice and consistent. It did dip in 2022 to 39%, but it is expected to go back up into the 40s in 2023. Now, net debt to EBITDA, it signals two things. Now, firstly, EBITDA, earnings before interest, tax, depreciation, amortization, signals firstly the dividend safety and secondly the balance sheet strength. Typically for REITs, we look for below 5.5. These are the number of years it would take the company to pay off all of their debt net of cash on hand. And we can see here 2023, it is expected to come down, but still above that 5.5. Now, typically on the channel, what we do is we run through the valuation model. We run through each model when we're looking at individual companies, getting to our essential intrinsic value. Now, Realty Income, we will run it through our model as we have only reviewed this recently on the channel. But for the other ones that we don't go through today, the next 6, do let me know if there are any that you want us to run through on an individual stock valuation model. And what we saw for Realty Income when we did take a look at it last time, what we typically do, well, intrinsic value, for those that are new, it is the average of the models we use. Graham's valuation, not applicable for REITs. We get the current price. Margin of safety at 10% is the minimum we look for if we believe it has a wide moat, strong financial metrics, and good forward-looking data. For Realty Income, 10%, it would be up to $61. At 15%, up to $57. So pretty much at the current trading price. And in terms of Wall Street and what they expect, well, they see the share price to go up 10%. So in conclusion, for Realty Income, we personally see around 15% margin of safety based on the current metrics and our judgments, with Wall Street expecting around 10% upside to the current trading price. And if you do want to grab a copy of this valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So the second REIT that Morningstar are saying is a strong buy for 2024, we have Equity Residential, which is nonetheless a residential REIT, currently forward yield of 4.25%, of which they believe is currently trading at a 28% discount from its fair value estimate. So let's take a look at the metrics. We see a dividend safety score of 61 being safe, market cap 23 billion, a large cap company. Recessionary metrics, well, they cut the dividend during the 07-09 recession, average growth during that period, and pretty much a near recession return of 58%. Dividend growth, very nice to see, above inflation increase at 6% this year, in line with inflation over the last 5 years, but over the last 20 years at 2% has been pretty poor in my opinion, and they have only been increasing their dividends for the last year. Now when we take a look at dividend yield theory, we can see that sign of undervaluation, 4.33 versus 3.36, and we see the forward P to FO at 19.4 versus 23.8. Now, when we compare it to the sector PE, we do see it, though, slightly higher or significantly higher at 19.4. Focusing on the payout, the adjusted funds from operations payout, we do see it below 90% pretty much every single year. 2022, 85%, 2023, 83%. So it does look like that dividend is safe so far based on the information we have. Adjusted funds from operation, well, 249 in 2013, 295 in 2022. It has increased over the last 10 years. Not very consistent, but it is moving in the right direction, with 2023 expected to go even higher. Now, when we look at the sales growth, double digits in 2022, fairly decent at 6% in 2023 expected. It has been fairly inconsistent. Some years double-digit growth, some years double-digit negative growth, and we can see when we do look numerically, it has gone from 2.4 billion to 2.74. Now, one of the biggest positives of this company so far is they don't dilute your position that rapidly in comparison to others. It has gone from 354 million to 389 in 2022. Looking at the ROIC, fairly positive. Remember, we're looking between 3 to 5%, 4% in 2022, 5% in 2023. Operating margin, very strong around that mid-30s. It has dipped for certain years into the 20s, but 2022 and 2023 expected is again expecting to be in the 31% region. Now, finally, when we look at the net debt to EBITDA, very strong in my opinion, 4.5 in 2022. Expected to go even lower in 2023 and 2024. So both the dividend looks to be safe as well as that balance sheet strength. As I mentioned earlier, if you do want me to run through any of these in our valuation model, then do let me know in the comments and we will have a separate episode for them. So the third one that we are looking at in terms of REITs to buy is Ventus. Now this is a healthcare facilities REIT which has a forward yield of 3.6%, and we can see Morningstar believing this to be 30% undervalued with a $72 fair value estimate. So let's take a look. We see dividend safety score of 60, borderline safe, 20 billion market cap, a large cap company. Now, in terms of key metrics, well, they maintained the dividend during the last recession, flat sales during that period, and they also beat the S&P 500 with a negative 47% return. Now, dividend growth, it hasn't been smooth sailing with no increase since 2020. On average, a decrease of negative 10% over the last 5 years, with 3% over the last 20 years, and we can see there has been no years of growth so far. Now, when we take a look at dividend yield theory, we do see a sign of overvaluation, 3.61 versus 4.01, but on the forward P to FFO, it does look reasonably valued with that forward P FFO at 19 versus an average of 18.9. When we do compare it to the real estate though, that is lower at 14.1. And when we focus on the payout, the adjusted funds from operation payout, we do see it for the majority below 95%, which is what we look for in the healthcare REITs. 2022 at 72%, 2023 expected 76%. Now, adjusted funds from operation, it has been decreasing, not exactly what we like to see. This is going in the opposite direction. 2023 is expected again to drop from 2022, so something just to consider as we go along the metrics for Ventus. Sales growth, not too bad, between that 5 to 10% over the last year as well as expected 2023, but we do see a year of negative growth as well as a few year period where it didn't even manage to get that 5 to 10% that we look for. Total sales, however, it is increasing 2.51 billion in 2013 to 4.12 in 2022. Typical of REITs, as we mentioned, 295 million shares outstanding in 2013, 403 in 2022. They are increasing that share count, but it isn't as rapid as we have come to see when we have been analysing REITs overall. ROIC, it is hitting at least a minimum of 3% over the last 3 years, with 2023 expected the same. So that isn't too bad, but might be something just to keep an eye on. Another thing that we would say is slightly worrying, their operating margin has been decreasing from 2017 at 14% in 2023. As this happens, it will mean that their bottom line net income margin will also be squeezed. So again, this is something very important to keep an eye on. Net debt to EBITDA 6 for the diversified healthcare REITs, 2022 6.96, 2023 expected 7.17. So again, there are a few metrics here that if you do like this company, you do believe it to be significantly undervalued like Morningstar, that I would say that you should keep an eye on for those metrics that we have just run through. The next company or REIT that we are focusing on is Apartment Income. Now this is essentially trading at a 30% below fair value of $50 per Morningstar, a residential REIT with a yield of over 5%, 5.16. Now when we take a look, we do see the dividend safety sitting at borderline safe at 50, market cap 5 billion with a mid-cap company. Now in terms of recessionary metrics, well, they didn't pay a dividend in 07-09, and during that period they had below average growth. What are we saying on the dividend growth? Well, no increase since 2022, -1 on average over the last 5 years, and over the last 20 years, -4%. And we can see here they have only been increasing those dividends for the last 2 years. Now, focusing on dividend yield theory, we do see that sign of undervaluation, 5.32 versus 4.23. Likewise, another sign with the forward P to FO sitting below that 5-year average of 18.6. Comparing it to the sector P to FO, it is pretty much near in line with 14.1 versus Apartment Income's 15. Now let's take a look at that adjusted funds from operations, and we can see it is around that 90% that we look for as a maximum, 83 in 2022, 85 in 2023, although it is expected to come down in 2024 to 80%. In terms of the adjusted funds from operation, well, it is also increasing, which is positive to see over the last 3 years. But 2023, it is expected to be pretty much flat or a small drop to 2022, with 2024 expecting to go back up and start increasing, going towards the right direction. Sales growth 5 to 10%, it hasn't been the greatest over the last 10 years. We see 3 years of some significant negative growth. 2022 at 4%, with 2023, which is positive to see, going back up to 8%. And if they do manage to continue increasing their top line, this could be an undervalued one for the future, or even a value play. Total sales, however, we have seen it decrease from 939 million to 720 in 2020, before picking back up, increasing around 50 million over the next 3 years. Share count as well, 114 million in 2013, 157 in 2022. So again, they are increasing their shares outstanding, similar to Ventus, but do note these are one of the essential REITs that don't dilute your position very rapidly in comparison to the sector average. ROIC, one thing to keep an eye on, it went down to 1% in 2020, although it has picked up to 2% in 21-22 and 23 expected, but I would like to see this go back up to the 2013-2017 numbers we saw. Operating margin, again, it has decreased from the highs of 2013-2014 down to 4% in 2020, but the positive sign here is it has started to increase, with 2023 being an increase on the previous year. Finally, we get to the net debt to EBITDA, remember, showing us the dividend safety and balance sheet strength. 7.43, which is huge in 2022. In fact, it was much higher in 2020, but it is very, very positive to see it coming down in 2023 to around 5.91, with 2024 coming even lower. So this could be a potential turnaround play, but it is hard to say based on the analysis we have done so far. We then move on to the fifth REIT to buy. Now this is one that Morningstar believe to have a 38% discount with a fair value estimate of $32.50, and we can see a yield of just under 6%. Again, similar to the other REIT, it is also a healthcare facility company. So let's take a look. We see here dividend safety of 60, borderline safe, market cap 11 billion, a large cap company. Now, in terms of recessionary metrics, well, they in fact increased the dividend during the last recession, -4%, so above average growth, and they still beat the S&P 500 with a -48% return. Now, they haven't increased their dividend since 2021, -4% over the last 5 years on average, and last 20 years, -2%. Now, dividend yield theory, we can see that undervaluation sign, likewise on the forward P to AFFO, so we have those two signals of undervaluation. In terms of the sector P to AFFO, it is slightly lower as well. Now, comparing the adjusted funds from operation year on year, we do see in actual fact for the healthcare, diversified healthcare REITs below 95%. It has been pretty much below that other than 2020 and 2019. 2020, just something to bear in mind, they paid out more in dividends than they generated from funds from operations. But the positive is not only has it started to come down, but year on year it is decreasing, with 2023 at 78%. So that is looking positive in terms of a turnaround. Adjusted funds from operation, not the greatest sign, the fact that it has gone from 252 down to essentially 135 in 2021. But in the following 2 years, it is expected to increase. So that is positive, but again, something just to keep an eye on if you are looking to invest in this company. Sales growth, we do see double-digit increases, but at the same time, we see double-digit decreases 3 of the 10 years. 2022, 9%, 2023, 7%. And over the last 10 years, in actual fact, if you were just to compare 2013 to 2022, it hasn't increased much. But when you see the drop down to 2018, it has picked up quite nicely. Shares outstanding, again, another one that doesn't dilute your position that rapidly as a shareholder in comparison to the likes of Realty Income. 456 million in 2013, 539 in 2022. ROIC, fairly low, consistently low in fact, 2% in 2022, although 2023 it is picking up to 3%, and I would like that to be a sign of things to come for the future, and would take a look at forward guidance if this was one that I would be looking to invest in. Operating margin, it has come down to around 17% in 2022, 2023 expected to be the same, again something just to keep an eye on moving forwards in terms of that margin. Bottom line, net debt to EBITDA, 6.83 in 2022, a positive sign. One, the fact that it's coming down in 2023 to 6.17, but also the fact in 2024 they are expecting this to be 5.44, so that could be a positive sign of things to come for the company and possibly see those dividends increasing again. Now, we move to REIT number 6, which is Pebblebrook Hotel. Now, this is one they believe trading below 46% its fair value estimate of $27.50. It isn't one with a high yield at 0.27%, and this is in the hotel and motel industry. So we can see here they haven't got a score just yet for this company. It is a 2 billion market cap. In fact, it is a small cap company. In terms of dividend growth, well, they haven't increased their dividend for quite some time, and over the last 5 years and last 10 years, it has been decreasing, as we can see here from this graph. Now, in terms of dividend yield theory, well, this company doesn't currently have that information, so we can jump straight into the free cash flow payout. So what we do see here is that whilst we do like to see below 60%, 2021 and 2022, it has been fairly low, so that is a positive sign to see. Now, when we compare the free cash flow per share, 140 in 2013, 177 in 2022, it is increased over the last 10 years, but you can see it has gone up and has gone down, so it is fairly inconsistent. Now, when we take a look at the sales growth, double-digit increase nearly every single year. 2020 had a huge drawdown, as we see, negative 73%. But it's very, very easy to understand why. COVID, a lot of people were essentially not allowed to go outside. The hotel and motel industry, it would be very hard for this business and industry as a whole to be booming during that time. And we can see the following 2 years, it had some significant growth. Although do note 2023, it is expected to be around 7%. Sales then $500 million in 2013, 1.4 in 2022. Shares outstanding, they have diluted your position if you were holding this over the last 10 years. In fact, twofold, from 62 million to 130 million. Finally, the ROIC, remember, 3 to 5%, 2022 at 2% is a bit of a worry. 2023, again, 1% something just to consider there on these metrics. Operating margin, we can see they did make a significant loss in 2020 and 2021. It has picked up, but it is fairly small in 2023, so something to consider. Look at management's forward guidance, as well as essentially looking at their latest annual report. Now, net debt to EBITDA, we would like to see this below 6.74 in 2022. It is coming down, but we can see it is on more of the higher side. Now, one thing to note, having looked at these metrics, when we do take a look essentially at the Pebblebrook Hotel discussion, they do say that the coronavirus outbreak did significantly affect their operating results, which is fairly easy to see based on the information we took. But they do believe they expect this company by the end of 2024 to recover and to essentially have the pre-pandemic levels. So it could be a turnaround play. And as always, if any of these companies you would like us to review in a lot more detail, we can do our standard reviews that we do on the channel, analysing fully these companies, what the institutions are doing, their balance sheet, their income statement, what we believe the evaluation to be, and we can run through all of that. So do let me know within the comments below. The seventh and final REIT to buy per Morningstar is Unity Group. Now, they believe this to essentially have a 52% discount to their fair value estimate. It is in the specialty industry in the REITs, and it does have a yield over 10%. So let's take a look at this company. Now, dividend safety 40, they believe it to be unsafe. Market cap 1.3 billion, another small cap company. Now, recessionary metrics, unfortunately, we have no data available to us, so we jump straight into the dividend growth. Now, we can see they had 0% increase since 2020, and over the last 5 years, it has been decreasing. So let's take a look at dividend yield theory. So we can see here a huge sign of undervaluation, 11 versus 6, as well as the forward P to FO at 3.8 versus 5.3. Now, when we take a look at that essential adjusted funds from operation payout, we look for below 90%. And we can see 2021, 2022, 2023 below 40%, which is a fairly positive sign. Now, in terms of the funds from operation per share, a less positive sign of 178 in 2015. It went up to 261 before coming down to 2021's 168. And whilst it has rebounded in 2022, it has then decreased in 2023. Sales growth, remember, 5 to 10%. We can see here that effectively the last 5 years, including 2023 expected, hasn't been even increasing in line with inflation. So something to consider. And numerically, we can see, if we focus from 2015, 710 million to 1.13 billion. It has increased, not massively and not keeping up in line with inflation. So it would be important to see how management expect to essentially counteract this for 2024 and beyond. Shares outstanding, very typical, as we mentioned, increasing the shares of the shareholders and company. ROIC, though, we can see some very positive figures. It is double digits nearly every single year. The last 3 years, 14, 18, 19%, with 2023 at 17%. Operating margin, very positive again to see. So this is a company that is showing some positive signs, and we can start to see maybe why Morningstar do believe this to be the most undervalued REIT. Between 37 to 50%, with the last 2 years in the 50s, 2023 expected to be lower, but still a very admirable 47%. Net debt to EBITDA, something to keep an eye on. 1 for that dividend safety, 2 for that balance sheet. 5.71 in 2022, which is something I could live with, near that 5.5 maximum. But 2023, it is expected to go up slightly higher, so something just to consider. So these are essentially the 7 discounted and undervalued, severely undervalued, in fact, REITs that Morningstar do believe. Now, we did run through all of these. We did take a look at realty income based on our own valuation model. If there are any of these that you do believe looked attractive based on our analysis, do let me know in your comments below your thoughts, and I can take a look individually at what we believe the valuation to be, whether we believe it to have some significant undervaluation like Morningstar, or if we believe that really it isn't one that does seem to be undervalued. Let me know your thoughts below. If you've enjoyed this type of content, smash that like button, hit the subscribe subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, if you do want to grab a copy of that valuation model, click on the pinned comment below. You can run your own companies through, or companies in your watch list, to get to their intrinsic value and essential buy price based on your investor margin of safety. As always, have a great day, happy holidays, Merry Christmas to those who celebrate. I'll catch you all in the next episode, and take care.